Most people who invest in cryptocurrency lose money for one simple reason. They buy when everyone else is buying. They see a coin's price shooting up on a chart, and they jump in. They hear about a new project on social media that is going to change the world, and they feel a rush. This powerful feeling is called the fear of missing out, or FOMO. It is a natural human emotion. We see others getting rich, and we want to be a part of it. We feel an urgent need to act now, before the opportunity is gone forever. This is a very common trap. Acting on pure emotion is almost always a bad idea when it comes to investing. The market does not care about your feelings. It only cares about supply and demand. When you buy because of FOMO, you are usually buying at a high price. You are buying after the big gains have already happened. The people who bought early are the ones who are selling to you. They are taking their profits. You are left holding the bag as the price starts to fall. This cycle of panic buying and panic selling is how many new investors get wiped out. They lose trust in the market and walk away. It is a calm, steady, disciplined method. It does not require you to predict the future or find the next coin that will go up 100 times in a week. Instead, it focuses on building a solid position over a long period. This strategy is designed to remove emotion from your decisions. It helps you avoid the classic mistakes that come from FOMO. It provides a simple plan, clear plan that anyone can follow, even if you are just starting out. This plan will help you navigate the wild crypto market with confidence and a clear head. The goal is not to get rich overnight. The goal is to build real, sustainable wealth over the long term. This requires a shift in your mindset. You have to stop chasing fast gains and start thinking like a strategic investor. You have to accept that you will miss some opportunities, and that is perfectly okay. You cannot catch every single wave. The important thing is to have a strong boat that can ride out the storms and carry you safely to your destination. This essay will give you the blueprint for building that boat. It will show you a strategy for 2026 and beyond that actually works. The first step in avoiding the FOMO trap is learning how to recognize it. It has very clear signs you can spot on price charts and on social media. One obvious sign, a series of very large green candles on a chart. A candle shows price movement for a period like one day. A big green candle means the price went up a lot, very quickly. Several in a row without a pullback is a warning. Extreme upward moves attract a flood of buyers chasing the price. A classic setup for a sharp reversal. Another major sign is overwhelming social media hype. You might suddenly see everyone talking about the same coin, Twitter, TikTok, Reddit. Influencers you follow might all post at once. Comment sections fill with rocket emojis and talk of insane price targets. That viral excitement creates powerful social pressure. It makes you feel like you're the only one not involved. You start to think it's a guaranteed win, which is rarely true. The third classic sign is the language people use. When you hear phrases like, "to the moon, 100 times potential," this is the next Bitcoin, your FOMO alarm should ring. Now that you know how to spot FOMO, you need a tool to fight it. The best tool is dollar cost averaging, DCA. This is the opposite of chasing pumps. A calm, automated way to build your investment over time. Simple to understand. Don't invest a lump sum all at once. Break it into smaller, fixed amounts. Invest those small amounts at regular, predetermined intervals. Do it no matter what the price is doing. Steps to implement DCA. First, pick a fixed amount you can comfortably invest. Make sure it's money you can afford to lose and won't cause stress. Example, $25 a week. Example, $100 a month. Second, choose a fixed time interval. Every Friday, the first of every month. Consistency matters more than the exact day. Third, commit to making that purchase on schedule, high or low. Ignore short-term noise. Stick to the plan. Why DCA works. It removes emotion from the equation. You stop trying to time the market. Buying the absolute bottom is extremely difficult, even for pros. DCA removes that stress. Your only choice is to stick to the schedule. It prevents impulsive buys during hype. It prevents panic sells during fear. Logic and plan, not emotion. DCA smooths your average purchase price over time. When price is high, your fixed amount buys fewer coins. When price is low, your fixed amount buys more coins. Over months or years, you accumulate more at cheaper prices. It can lower your average cost versus a lump sum buyer at a top. A systematic way to use volatility, not be a victim of it. Resisting the urge to jump in during peak hype is one of the most profitable skills you can learn. You also need to decide what to buy. A smart way to structure your crypto holdings, especially for beginners, is the core satellite model. This approach is all about balancing risk and potential reward. It helps you build a strong foundation for your portfolio. It also lets you take calculated shots on higher growth opportunities. It gives you a clear framework for allocating your capital. That prevents you from putting too much money into overly risky assets. The core of your portfolio is the foundation. This is where you should allocate the majority of your investment capital, typically between 60% and 80%. 60%, 80%. Show pie chart labeled Core 80% and Satellite 20%. The assets in your core should be the largest projects in crypto, most established, most secure. For most people, this means Bitcoin, Ethereum. They have the longest track records, the most development activity, the highest security, the widest adoption. They are still volatile and carry risk, but they're considered the blue chips of the crypto world. Your core is designed for long-term, steady capital preservation and growth. The satellite portion is where you take on more risk for potentially higher returns. Allocate the smaller part of your capital here, typically between 20% and 40%. 20%. 40%. The assets in your satellite are smaller cryptocurrencies, altcoins, decentralized finance, gaming, data storage. These assets are much more speculative. They can grow much faster than Bitcoin or Ethereum, but they also have a much higher chance of failing completely and going to zero. When choosing satellite assets, do careful research. Don't buy just because it has a funny name, or because someone on social media is hyping it. Look into the project's team, its technology, its real-world use case, its tokenomics, supply and demand rules. The satellite portion is where you experiment, but only with a small, defined part of your portfolio. That way, if all satellites fail, your core remains safe and protects you from catastrophic losses. Let's walk through a clear practical example to see how this all comes together. Imagine you have decided to invest $1,000 into cryptocurrency. You are a beginner and want to follow a relatively conservative plan. You choose an 80-20 core satellite allocation. This means you will put $800 into your core holdings and $200 into your satellite holdings. This allocation immediately defines your risk. No matter what happens, the bulk of your capital is in the more established assets, which provides a psychological and financial buffer against volatility. For your $800 core, you decide to split it between the two largest cryptocurrencies. You allocate $500 to Bitcoin and $300 to Ethereum. These are your foundational assets, your anchors in the volatile crypto sea. For your $200 satellite, you do some research and find two smaller projects that you believe have long-term potential. Perhaps one is a leading project in the decentralized Oracle space and the other is a promising Layer 2 scaling solution. You decide to allocate $100 to each of these two altcoins. Your entire portfolio structure is now clearly defined. Now, you apply the dollar-cost averaging strategy. Instead of investing the full $1,000 all at once, you decide to DCA over a period of 10 weeks. This means you will invest $100 every week. Each week, you will invest that $100 according to your allocation percentages. So, every single week for 10 weeks, you will buy $50 of Bitcoin, $30 of Ethereum, $10 of your first satellite coin, and $10 of your second satellite coin. You can set this up automatically on many exchanges, making the process effortless. You are now systematically building your positions without worrying about the daily price swings. This combined approach provides immense benefits. The core satellite model gives you a balanced portfolio that manages risk. The DCA method removes the stress of market timing and helps you build your positions in a disciplined way. If the market goes down next month, you will not panic. You will know that your weekly purchase is simply buying you more coins at a better price. If the market soars, you will not feel FOMO because you are already participating with your planned weekly investment. This calm, methodical process is the key to surviving and thriving in the crypto market long term. Beyond the mechanics of DCA and portfolio allocation, long-term success in crypto investing depends heavily on managing two things: risk and your own psychology. These are the unseen skills that separate successful investors from those who get burned. The first rule of risk management is simple: never invest more money than you are willing to lose. The crypto market is still young and incredibly volatile. Even the most established projects can experience massive price drops. Your crypto investments should not be money you need for rent, groceries, or emergencies. Another key part of risk management is securing your assets properly. If you are just starting with small amounts, using a large, reputable cryptocurrency exchange is generally fine. Make sure you enable all the security features they offer, especially two-factor authentication. As your holdings grow larger, you should learn about self-custody and consider moving your assets to a hardware wallet. A hardware wallet is a physical device that keeps your private keys offline, making it nearly impossible for hackers to steal your funds. Remember the phrase, "Not your keys, not your coins." Just as important as managing financial risk is managing your own emotional responses. FOMO is a powerful force, but so is its opposite: FUD, fear, uncertainty, and doubt. During a market downturn, social media will be filled with negative news and predictions of a total collapse. This can create panic and lead you to sell your assets at the worst possible time, at the bottom. Having a written plan is your best defense against both FOMO and FUD. When you feel panic, you can look at your plan and remember why you invested in the first place. A simple trick to control your emotions is to create rules for yourself. For example, a 24-hour rule. If you see a coin pumping and feel the urge to buy, force yourself to wait a full 24 hours. After that time has passed, the initial emotional rush will have faded, and you can evaluate the opportunity more rationally. Another great habit is to limit how often you check your portfolio. Looking at prices every 5 minutes will only amplify your anxiety. Check once a day, or even once a week. Your strategy is automated and long-term, so the daily noise does not matter. Finally, it is crucial to remember that investing in cryptocurrency is a long game. The stories you hear of people getting rich in a few weeks are the rare exception, not the rule. They are the lottery winners of the financial world. True wealth is not built by gambling. It is built through patience, discipline, the power of compounding over time. Your goal should be to stay in the market for years, not days or weeks. This long-term perspective allows your strategy to work its magic, smoothing out volatility, slowly accumulating value. You will inevitably miss out on some massive pumps. You will see a coin go up 500% in a month and feel a pang of regret for not buying it. This is a normal feeling, and you have to learn to accept it. It is impossible to catch every single winner. By sticking to a disciplined plan, you are trading the small chance of a massive quick win for the high probability of a solid long-term gain. You are also protecting yourself from the huge number of projects that fail. For every coin that goes to the moon, there are hundreds that crash and burn. Your calm strategy helps you avoid those. The plan outlined in this essay, spotting FOMO using DCA, building a core satellite portfolio, is not glamorous. It will not give you exciting stories to tell your friends next week, but it is effective. It is a proven path that has worked in traditional markets for decades and applies perfectly to the world of crypto. Small, consistent actions repeated over a long period lead to remarkable results. It is about laying one brick perfectly every single day. Eventually, you will look back and see that you have built a fortress. So, as you navigate the crypto market in 2026 and beyond, resist the urge to chase. Embrace the quiet power of a disciplined plan. Stay patient during the downturns. Stay humble during the upturns. Keep learning. Always do your own research before making any investment decision. Only use well-established platforms to keep your assets safe. Your future self will thank you for choosing a strategy based on reason and patience rather than one driven by hype and fear. That is how you win the long game. If you're ready to start implementing a DCA or portfolio strategy, I've linked a beginner-friendly exchange in the description that I personally recommend for secure investing and recurring buys. Always do your own research. And invest responsibly. If this helped you see crypto from a calmer perspective, subscribe to Silent Ledger, where we focus on smart investing, disciplined strategy, and building wealth without the noise. Invest smart, stay patient, log it on the Silent Ledger.